Financial markets may be misunderstanding one of the most important economic signals right now, the nature of inflation itself. Recent US inflation data has clearly moved higher, with consumer and producer prices remaining elevated. Many investors immediately interpret this through the traditional lens. High inflation means the economy is overheating, and central banks must respond with aggressive interest rate hikes. But the current environment may be very different from past inflation cycles. A growing number of analysts argue that today's inflation is being driven less by excessive consumer demand and more by external supply pressures, particularly energy markets and geopolitical uncertainty. Rising oil prices increase transportation costs, manufacturing expenses, and the price of everyday goods across the entire economy. In this type of environment, inflation is being pushed upward by costs rather than by booming economic activity. That distinction matters. In a classic overheating economy, wages rise rapidly, consumers spend aggressively, and businesses expand capacity. Today, however, many households are facing weaker purchasing power as living costs rise faster than incomes. Consumer confidence indicators have softened significantly, suggesting that economic momentum is already slowing in several areas. This creates a difficult situation for central banks. Higher interest rates can slow borrowing and reduce domestic demand, but they cannot directly resolve energy supply disruptions or geopolitical tensions affecting commodity prices. As a result, policymakers face a narrow path. Inflation remains too high to justify rapid rate cuts, while economic conditions may not be strong enough to support much tighter policy either. Because of this, markets are increasingly focused on external developments rather than purely domestic economic indicators. If energy prices stabilize and geopolitical risks ease, inflation pressures could cool more quickly than expected. That in turn would likely shift market expectations for future interest rates and global liquidity conditions. Financial markets tend to react before consensus fully changes. Assets that are highly sensitive to liquidity and monetary policy expectations, including precious metals, could ease renewed interest if investors begin anticipating a softer inflation environment and eventual policy adjustments. At the same time, the long-term structural case for precious metals remains intact for many investors. Central banks around the world continue increasing gold reserves, while concerns surrounding debt expansion, currency diversification, and long-term monetary stability remain part of the broader global conversation. For now, the key variables investors are watching are energy prices, inflation trends, and shifts in interest rate expectations. Together, these factors may shape the next major phase of global financial markets.